Begin the seventh in the series, I like that, the seventh in the series of hearings conducted by the Joint Fiscal Committees of the Legislature regarding the Governor's proposed budget for the fiscal year 2015-2016. The hearings are conducted pursuant to Article 7, Section 3 of the Constitution and Article 2, Section 31 and 32A of the legislative law. Today, the Assembly Ways and Means Committee and the Senate Finance Committee will hear testimony concerning the budget proposal for taxes. I will now introduce the member of the Assembly, and Senator Francesco, Chairman of the Senate Finance Committee, will introduce members from the Senate. With me today is Assemblyman Kuzik and Assemblyman Oates and Senator
Kruger, the ranking member of the committee, as long as Tom Croce and Diane Savino, they're here as well.
Good morning.
Good morning, Chairman DeFrancisco, Chairman Farrell, and members of the Senate Finance and Assembly Ways and Means Committee. My name is Noni Mannion. I'm the Executive Deputy Commissioner at New York State Department of Taxation and Finance. I have with me today Amanda Hiller, who is our General Counsel. I'm pleased to have the chance to highlight for you today the tax components of Governor Cuomo's Opportunity Agenda, which sets forth a policy built upon three main goals. The first being, make it easier for families and individuals to live and thrive in New York State. Second, make it easier for businesses to flourish and create jobs in New York State. And third, set and maintain a level playing field featuring simplified tax compliance for everyone. We began making New York State a more affordable place to live in 2011 by implementing the real property tax cap. The cap turned around runaway growth, which was averaging 5.3% annually and had been as high as 7.7%. Newly empowered voters in 84% of local governments and 97% of school districts have ensured property tax compliance. The property tax freeze credits have helped drive cap compliance by offsetting property tax increases in cap-compliant jurisdictions. We're finalizing the distribution of $200 million in credits to 2.5 million homeowners, and the three-year program will ultimately put $1.5 billion back in the pockets of New Yorkers. The executive proposal will deliver another $1.7 billion in relief to New Yorkers through a new real property tax credit. 1.3 million taxpayers will see an average benefit of $950 when the program is fully phased in. Last fall, we also distributed more than $360 million in advanced refunds as part of the Family Tax Credit Program, which provided $350 checks to more than 1 million families. Together, these programs are returning billions of dollars to New Yorkers at a time when they need it most. The executive budget also makes New York State a more attractive place to do business. It expands upon the business tax reforms enacted in last year's state budget by reducing the corporate income tax rate to 2.5% for small companies. We also help our burgeoning craft beverage and agricultural industries. The proposal extends the current tax exemption for wine tastings to cover similar tastings conducted by breweries and farm distilleries, and ensures fuel used in farm activities is eligible for refunds under the petroleum business tax exemption. All of these initiatives depend on taxpayers meeting their obligations in a complete and timely manner, and we aim to establish a fair and level playing field on which they can do so. The governor's budget empowers the tax department to recover inappropriately claimed STAR exemptions and benefits. It also expands upon the enormously successful driver's license suspensions program that was initiated in 2013 by lowering the threshold of warranted tax delinquencies from $10,000 to $5,000. Last year, facing the risk of driver's license suspensions, thousands of New York taxpayers came forward to settle their liabilities. The program has generated $125 million in collections since its inception. Taxpayers currently fund a $127.4 million program that purchases free excess medical malpractice insurance for physicians and dentists. The budget proposes to withhold this taxpayer-funded privilege from physicians and dentists delinquent in their tax obligations. And the plan also institutes a tax clearance for a number of business and professional licenses and prohibits state agencies from hiring employees who have not passed a tax clearance. We're using data to better target enforcement and ensure a level playing field among privileged licensees. The department operates one of the most sophisticated data analytics systems in the world of taxing authorities, which helps us focus enforcement on non-compliant taxpayers. In 2011, the department established our Fraud Analysis and Selection Team. We call it FAST. This has uncovered more than 1,500 distinct fraudulent refund schemes, saving New Yorkers $260 million. The Federation of Tax Administrators awarded the department its 2014 award for Outstanding Technology Application for our fraud prevention strategy. We're more user-friendly today than ever before. Taxpayers can now conduct virtually all of their business with the department online. We offer 80 different services through taxpayers' online accounts, which are now used by approximately 2.2 million taxpayers. And e-filing is on the rise, with nearly 90% of individuals filing electronic returns in 2014. I'm energized and excited for the future. Governor Cuomo's opportunity agenda includes a well-balanced tax agenda that will make New York State more affordable for individuals and families, more hospitable to job-creating businesses, and more fair for everyone. I look forward to administering this bold package and promise we'll continue to do so according to the very high standards that we've established for ourselves. I'm eager to hear your ideas and input, and I look forward to taking your questions.
Thank you. Mr. Cusick?
Thank you, Mr. Chairman. Commissioner, thank you for testifying here today. I just have a question on the education investment tax credit proposal by the governor. Could you just explain a little bit about it? Because I think there's some confusion out there from some of the opponents of this. Could you just clarify what this tax credit is and what it would do?
Yes, the tax credit encourages individuals and corporations that would like to donate to educational process, and it could be for public or non-public education. The role the tax department plays in it is to ensure that people that are taking the credit are taking up to the $1 million per individual or per business, and that we don't exceed the $100 million cap. So the way the credit works is the individual or business that's making the donation gets a credit for 75% of that amount. People will apply to be able to take that credit, and initially the department will be looking at those applications, taking them all in at once, and then if it goes over the $100 million cap for the state, what we'll do is we will be allocating among all the applicants and determining how much they can take. If it doesn't go over the $100 million cap, there will be additional applications that we'll receive, and it'll be on a first-come and first-served basis.
Okay, and just to be clear, the tax credit goes towards the person who donates, not to the people who send their children to the school.
That's right. The tax credit is for the person that donates. It encourages the philanthropic activity of donating to education.
And the $100 million threshold is lower than the 300 that was presented by the legislature in the bills, correct? This is lower, the $100 million.
The budget is $100 million.
Yes.
Yes.
Okay. Thank you, Commissioner. Thank you, Mr. Chairman.
Thank you.
Senator Savino.
Thank you. Thank you, Senator DeFrancisco. I have a couple of questions. I'm going to kind of jump around a little bit, but I wanted to focus on one of the things that the governor's talked about is reducing the property tax burden. He's focused a lot on over the years. We've done the property tax cap. Now he's discussing the idea of a circuit breaker, which I think in the past the Senate had passed it numerous times. So we're happy to see that, but I'm a little confused about how it's going to treat the residents of New York City, of which I happen to be one of those homeowners. So if you could kind of walk me through how a New York City homeowner and a renter will be treated under this circuit breaker proposal.
On the current real property tax credit, a New York City homeowner or renter would be treated by looking at how much their property tax is, and comparing that to what they've paid and what their income is. So if they've paid greater than 6%, and their income is under a certain dollar threshold, they would be getting a credit. They would be allowed a credit. The way it's working for renters is we are figuring that 13.75% of the rent is for their property taxes. So if a person is paying whatever their rent is, 13.75% is assumed to be part of the property tax. So we would look at that amount and compare it to their income to determine if they would be eligible for this credit.
Do you expect to take into consideration the mix of taxes that New York City residents pay? Because just as you know, our property taxes are lower compared to suburban areas, but we also pay personal income tax in New York City. Is that going to be taken into consideration when you determine eligibility?
The New York City taxing structure is different from the rest of the state, and that's been recognized through the different programs that deal with the property tax. Initially, when the STAR program was put in place, the actual income tax was reduced in New York City. There's been a real property tax credit, there's been a circuit breaker, so there have been a number of things that have been put in place to make sure that New York City is included.
My understanding, though, is under the current proposal, New York City homeowners, by and large, are not going to be able to take advantage of this because we're not going to pay enough of a percentage of our income in property taxes. So I would just hope that we might find a way to take into consideration the increase tax burden that New York City residents pay. I mean, we're 43% of the population of the state of New York, and we're not getting much out of this. So I would say we should consider expanding it to include personal income tax as part of our overall tax burden when we make determinations about the circuit breaker. One of the other questions I had, if you're a renter in New York City and you're living in like the New York City Housing Authority, where they don't pay property taxes, how will a renter who lives in either subsidized housing or a property that does not currently pay property taxes, how would they become eligible, or are they eligible?
I believe they would be eligible. There's nothing in the bill that would preclude them from being eligible.
If I can just expand upon that, the real property tax credit is structured to provide a benefit for homeowners for the property taxes, and it also provides a benefit for renters by essentially having a calculation of a property tax equivalent, because renters are paying the property taxes of their landlords through their rent.
That I understand.
So a portion will be taken to provide for that credit.
That I understand. What I'm asking, though, is in properties that don't have currently a property tax bill because they're exempt, how would you calculate the value of the benefit to people for whom? So in a traditional apartment building, a landlord has to pay New York City property tax, and a percentage of that of the rental roll is devoted to a portion of that property tax. That's how you determine rent. But if you're in a property that doesn't pay property tax, that's the question I'm asking, and maybe it's just...
The calculation of the rent equivalent isn't related to the property tax bill of the property. It's strictly for renters whose rent equivalent is over the income threshold.
All right. I just want to move on. I have one or two more questions on a different issue. I noticed also the governor's talking about this employee training incentive program tax credit, because we want to incentivize employers to prepare our employees for, changing. How will we determine what programs would be eligible? What can we do to prevent against fraud? I'm concerned about employers who just claim that they're sending their employees for programs. Who's going to supervise these programs? Are they going to be licensed by the state? Are they going to be approved by state ed, by the Labor Department? How do you envision this working?
It's the Department of Labor that would be looking at those programs to making sure that they're meeting the requirements.
It would have been nice if they had told us about that the other day when they were here, but in any event, do I have another question? No, I don't think so, John. I might have one later if it comes back to me. Thank you very much.
Thank you. Mr. Oakes.
Yes, thank you. Last year, the property tax freeze, municipalities complied. There was a rebate check that went. We are still hearing from some individuals saying they haven't received that. So, reasons for the delay over this last year?
I'm pleased to report that the last of the checks are going out right now. Some of the reasons for the delay is Being the first year of the program, and we had to receive information from many different school districts throughout the state, there are a number of them that use the standard format, and we were able to provide the analysis to make sure we were issuing the right amount of check to the right person in pretty expedient way with the people that had standard formats. Others, the formats are a little different, and then there are some other localities where they don't actually do their rolls until later. So we were receiving some files as late as the end of November, December. And then the due diligence that was required to make sure that we were paying the right amount of the freeze check and making sure it went to the right individual took us a little longer in this first year. We learned a lot. We know that we're going to be working with the different locals and the different school districts to get a more standard format for the file so we could do it better in this next year.
So your confidence for the second year of that is that we should have that more in a timely fashion, that people will be receiving them?
That's our objective, definitely our objective. And as you know, in the second year, we are not only required to be looking at the taxes, the school taxes, we also have to be comparing the local taxes. And there are a lot of different jurisdictions within those local taxes. So we have many more files to be working with. We're using our lessons learned from the first year, and we'll be working with the locals and the schools much more upfront, checking the files as they come in and going back to them and asking for some correction. So that we could do it in a much quicker way.
In this budget, there's reductions proposed for the corporate franchise tax for qualifying businesses. And do you have a sense, one, the number of businesses that operate in New York under the corporate franchise tax versus personal filings? Do we have those numbers?
The number that would fall into, that would be able to take advantage of this reduction in the corporate tax for small businesses that goes down to 2.5%, which is the lowest rate that it's ever been. There's about 42,000 businesses that fall into that. A number of small businesses, with a small business, you can structure yourself in a lot of different ways. There are about 42,000 of them that structure themselves as corporation tax. So therefore, they're paying corporation tax, and then as they pay individuals, they're paying on their individual income tax. A lot of other small businesses structure themselves as partnerships or flow-through entities, where the income actually flows down to the individual. Those people have actually been able to take advantage of the decreased personal income tax rate that was put in place a few years ago. So they've already been able to receive a reduction in their tax.
Do we have a sense of the total number then of businesses? You know, you'd said it's going to affect 42,000.
Yeah.
What's the total number?
We don't have that. We don't have that number because, as I mentioned before, they're structured in a lot of different ways, and so therefore it gets very complicated. It's not like one business, one tax return, because it could be coming in on multiples.
And the total amount of the tax break this year and then when fully phased in?
Do you have that number?
The total amount of the tax break? It's a reduction to a 2.5% rate on businesses that are under 290,000. So
The total value of that? We can get
for that.
Okay. One of the proposals in the executive budget I found was on the ability to share data with state agency looking for outstanding tax liabilities. Just issues around privacy, concerns for that, and what the department is doing to make sure that we don't have breaches of that.
We're very serious about tax secrecy. As many of you know, when you ask about issues for your constituents, very often you hear from us that we can't discuss the details. The same type of secrecy has to be taken into consideration when we're working with other agencies. However, I mentioned before our data analytics and the system that we have in place, and we have a lot of information that will help to focus enforcement efforts, not only for the tax department, but for other agencies, for businesses that are not compliant. And so if we need to do an inspection of certain businesses, we should be doing that inspection of those where we feel there might be an issue. So what we want to do is build the intelligence around the selection for all of the enforcement activities for the different agencies, yet understanding the secrecy provisions. So within the bill, it actually says that we would not be providing based on individual, we would be saying, here is a group that potentially could have issues, and not giving the specifics as to how they were selected so that it could never get tied back to that individual business or that individual person.
And then my last question, also found that there is an expansion in the budget, proposed budget, to have the Excelsior Jobs Program expanded to entertainment companies. Is there an intention on a certain specific targeted company, or?
Not that I know of, yeah.
Thank you.
Thank you, Senator.
Senator Krueger.
We've been joined by Assemblyman Lefferts.
Thank you.
Thank you.
Good morning. Jumping back to Assemblymember Kusak's question about the educational tax credit, I think there's also some confusion about the difference between a charitable deduction under existing tax law and this educational tax credit. So if I make a contribution under existing law to a charitable organization of $1 million, what would you estimate the deduction to my New York State taxes would be on that $1 million charitable contribution?
What we're looking at is that charitable contribution would have to be added back so that it wouldn't be.
I'm sorry, I didn't hear that.
It would have to be added back. So if it was.
No, if we didn't change anything,
Oh,
just
if we did-
today.
Okay.
If I make a $1 million contribution to a 501c3 organization.
Yeah.
And I am an individual who obviously is in probably the highest tax bracket. What is the deduction from my New York State taxes for a $1 million charitable contribution?
I mean,
I mean,
would-
we'd have to do the math on that. You know, it's a bracket issue. If your income, right now, we currently have some restrictions on the deductibility of charitable contributions for people in the higher income brackets. In fact, this budget proposes to extend that reduction in the charitable contribution. But under current law and as proposed, if your income is over $10 million, you're allowed a 25% of the deduction otherwise available. So it would be a very scaled back deduction. And presumably, if you're making that level of a contribution, you're probably at an income level that has reduced deductibility.
So let's say I have if I'm making a $1 million contribution, let's say I have a $5 million income that year. Under current law, what do you project my tax deduction from New York State taxes would be on a $1 million contribution?
You know, I don't have,
What's the
I can't do
maximum
I
it
can't
could
do the
be?
math in my head.
Right.
But we, with incomes between $1 million and $10 million, we reduce the deductions for charitable contributions by 50%. So there would be some reduction, but I can't do that math in my head. We can certainly get back to you on that.
But the maximum conceivably would be a 25% deduction on $1 million?
Right now, if your income is between $1 million and $10 million, we reduce your charitable deduction by 50%, and if it's over $10 million, we reduce it down to 25%.
So I would get a deduction on the 500,000 instead of $1 million.
Yeah, if your income's $5 million.
Okay.
Yeah, I mean,
So it would
there's
be-
math there. I can't
So
do
the
that in my head.
maximum deductibility on a 500,000 contribution is 25%?
On a $500,000 contribution, again, it depends on your income
Right.
as to what the extent of the deductibility would be.
Right. But at the high, I'm just saying, give me the highest level of that contribution could be.
At-
That charitable deduction could be valued at for me, for tax purposes.
If your income is $1 million, but you have assets and you're giving a $1 million contribution, you know, but your actual income is under $1 million, you're going to get a deduction of 100% of that contribution. It's going to, you know, your actual rate of taxes will depend on your income. So again, it's math. It's possible to have a lower income and still have the
Now, I'm
assets to make
assuming
the
a $5
contribution.
million income, $1 million contribution, you're telling me that you would lower the maximum value of that contribution to $500,000?
We would.
So I'm
right.
asking you, I have a $5 million income, you're allowing me a taxable charitable deduction on $500,000. What is the maximum deduction value of my contribution for New York State tax purposes?
It would be 500, if you'd be deducting
No,
500,000.
how much would you be lowering my taxes?
I don't know the math on that.
You
But we
don't-
can certainly get that for you.
Okay, but I think
don't
it
have the
couldn't
rate
be more
table.
than 25% of the value of the contribution.
That's certainly possible, but, we can get back to you with the math. I need to look at a rate
Are you
table
gonna
and
interrupt me?
calculate it.
No, I was just going to say that it's nice that you're thinking about $1 million contribution. It's, but you should talk to your campaign, your accountant instead.
I'll be removing the mic. Follow-up question. Under the proposed educational tax credit of the governor, if I make a $1 million contribution to one of these newly defined or not yet defined educational entities, what is the value of the tax credit I would get from my $1 million contribution?
You would be able to deduct $750,000, 75%.
$750,000.
You could deduct that from
Got it.
your income.
So you would agree that the value of an educational tax credit deduction is dramatically, if not radically more than the taxable deduction under existing non-for-profit contributions in New York State law?
With the criteria that you set forth, I would say that, yes.
I think it's criteria that would exist in law. So, all right, thank you for that. Moving on, going to the renter's tax credit. A section of the law appears to say that it provides the New York State Commissioner of Tax and Finance the authority to unilaterally reduce the adjusted rent for the purpose of computating the tax credit if he or she determines that the rent amount is excessive to an amount substantially equivalent to rent for comparable housing units in New York City. So this is, I think, a new power given to you, the power to reduce people's rents. How do you plan on using the data to determine comparable value of different rental units with different rents in order to make this happen?
I think we're going to use analytics to try to do the best comparisons that we can do to see if there's some significant outlier across the data pool.
Across, sorry, neighborhood?
Across the data pool.
Across the
that
data-
comes in.
So if
Because we
you,
do in-stream analytics.
so if you come across a group of apartments in New York City that seem to have disproportionately higher rent for equivalent units with other units in New York City, you actually will have the power to say that rent is too high and lower the rent.
Nope.
Just confirming that.
I'm looking at my
Sure.
council.
This is Joe Gerberg, our counsel.
He's our real property.
There's another chair and another microphone.
going to sit on her lap.
This is our real property tax guru.
Great. I love gurus.
Well, I don't, if your question is, does the tax department have the power to actually reduce rents? No, that's not the case. When we compute the credit that they'd be entitled to, if we determine that the rent that they're paying is excessive compared to the market, we will compute their credit based on the market rent, not the actual rent.
Okay, so you will give them a credit based on what you believe their rent should be,
Correct.
but not order their rent to be lower?
That's correct.
Okay, I think if you read the language in the Article 78 bill, there's some room for a different interpretation. But if you're going to say that rent should be lower for computing the tax credit, that means the person is eligible for a lower tax credit because you actually thought their rent should be lower, but you're not lowering the rent?
We are, we're giving them a credit based on, I think concept is that if the rent is out of line compared to what the value of the rental property is, we aren't going to go, if the tenant is paying more than they should be paying, we're not going to cover that part of the rental payment. We'll cover what the rent should be, again, what the market says the rent for a property of that character should be. We will give them the credit on that basis.
So I'm being overcharged for the value of my apartment. I don't really have any control of that in the New York City rental market. We have a housing crisis. People are desperate to hold on to their homes. But you, the Department of Taxes, determined that I'm really paying too much in rent, and hence you're going to calculate a tax credit at a lower amount for me, even though you admit I'm paying too much in rent. So I get a double hit. I'm paying more than I should in rent, and I have no control over that. And now I'm going to get a lower tax credit from the state of New York because you've determined my rent is too high, but you can't do anything about that?
I think what we're looking for is outliers, those that fall really outside of it, because whenever we're talking about credits, there are some things that get reported that are not necessarily accurate. So if it's, you could have, if somebody is living, it's not an arm's length transaction. So somebody could be reporting rent that they may not actually be paying, but be able to get the benefit from the rent. So it's to stop the questionable filings.
I didn't hear the final sentence, I'm sorry.
It's to stop questionable filings. So we would be identifying those that are falling outside of the norm, and we would be asking some questions too, to see why it is that they're paying the rent that's so much higher in that area, and have them do the validation before we would actually deny the credit.
And if I could just add, the renter's credit that we're talking about is as a surrogate for the property taxes, and people may be paying rent that's above market rate for a variety of reasons that are about the New York City housing market. But we're trying to capture that portion of the rent that is attributable to property taxes broadly. And for some tenants in some apartments, we may be able to get a sense of what that property tax burden is separate and apart from what the rent is. And, it could be a building with really high amenities that isn't taxed that way, and that is an outlier in that way.
My time is up, so I have to come back later, but I guess I'll highlight, if the Department of Taxation is going to be able to document that there are people who are paying far more in rent than they ought to based on comparable market value, that would be valuable information for lots of people to have, because maybe then we could actually challenge illegal overcharges, which we see so often in rental markets in New York City. So my time is up. I'll come back.
Okay.
Assemblyman Weprin?
Thank you, Mr. Chairman. Thank you for coming this morning. I'm going to do a couple of questions in the area of the STAR program. I know there's a change in this year's budget. I represent a district in Queens that's probably about a third homeowners, a third co-op owners, and a third renters. I understand it's the traditional STAR program as we knew it is now going to be converted into an income tax credit. Is that correct?
Yes, that will happen for new purchases.
Okay, so when you say new purchases, if someone is a homeowner and has had the STAR exemption for, X number of years, that'll continue for now?
That'll continue in the same way for now. Yes.
Until when?
Until the property changes hands. So it's indefinitely, as long as they own that property.
And one of the things about the STAR program was, I think once someone signed up for it, and we had a whole campaign to get people that were eligible for STAR to sign up for it, that they didn't have to renew it every year, that it was automatically, they were in the database, and they received that STAR exemption. Is that still the case?
Yes, it is still the case. We had the registration last year, where people came into the department and they did the re-registration for STAR. And through that registration, we were able to identify some people that weren't necessarily eligible for it. and we've been able to take them off of the star rolls, and also there's legislation where we can go back and collect back star benefits.
Okay, can you tell me the distinction between the $250,000 figure and the $500,000 figure? There's a circuit breaker now. Is that going forward? Is that, say somebody that's been getting a star exemption, what's the dollar amount that applies?
Okay, the distinction with the tax credit now is to provide the benefit to people that need it most. The tax cap is working. I mentioned in my testimony that 84% of the local governments and 97% of the schools have stayed within the tax cap. So with the tax cap, with it staying low, the growth staying low, and with the freeze checks that were recently sent out to 2 million plus property owners, the people that receive the freeze check, basically their school tax is the same as it was in 2013. What the credit is now is that the credit is to provide additional benefit to those that need it most. So for people that make under $250,000 and their property taxes are greater than 6% of their income, it will be providing them with a credit that will help to offset that.
Okay, and this renter's tax credit, is that something that does not exist now but will exist going forward?
It did not exist. It's for the same. It's for people that need it most. So it's people that are paying rent. A portion of their rent, we've calculated it at 13.75%, is for property tax. So if that amount goes, if they're paying greater than 6% of their rent, the 13.75% of their rent, they would be afforded that credit. However, I have to qualify, it's only for those that are cap compliant. So for schools and local governments that are cap compliant.
Okay, and for family income, it's only up to $150,000 for the renters?
$150,000 for the renters, $250,000 for the homeowners.
Okay, thank you very much. Thank you, Mr. Chairman.
Thank you. Senator?
Getting back to the education tax credit, there's a limited amount of money, 100 million, is that what it is? And let's suppose that Senator Krueger gives $1 million, and others do the same thing. And it gets to the point where there's too many applicants, and you got to apply first, right? You got to be approved. All right.
Correct.
So now, what day is it being cut off? Is there a set date what's going to be cut off so I know whether a contribution is going to be, the credit's still available? How will I know that?
I believe it's January 15th.
That's right.
So applications will come in up until January 15th. We'll compile all those applications and determine whether it goes over the 100 million. First, we'll look to make sure that they're not looking to donate more than $1 million. So each individual or corporation can only donate up to $1 million. The total cannot exceed $100 million. So what we would be doing is if it comes in at 120 million, if there are applicants that want to donate 120 million, we would be prorating the amount that they can take as a credit.
Okay, I got you.
Yep.
I got to do one step at a time so I can
Sure.
follow it. So the applications come in, and the amount, let's say the amount is 110 million.
Okay.
That's what they're applying for, as what, they're giving you what they want to donate.
Okay.
Is that correct? The 100 million, 120, it's determined by the application what is requested to be donated, or the credit they intend to get?
The 100 million is the credit. So therefore, if a person wanted to take $1 million of a credit, they would have to donate, I think it's like 1.3 million.
Okay. All right. So now we get down to January 16th, and there's too many credits. Do you automatically prorate it at that time, so the person will not give 1,300,000, but that what they'll give is less because there's a less credit? Are you stuck to the amount of donation that you applied for?
We would prorate it. We would inform them as to how much of their donation would be covered by the credit.
And then they could then make that donation, whatever the number may be.
Right. And they could donate more if they'd like.
No, I understand that, but they haven't yet, so it doesn't seem to think it's going to happen. All right, so now we go, after the proration, now let's say it's the credit's less than the 100
Yes.
million, then you open it up to applications again?
We'll continue to receive applications, and it will be on a rolling basis. So until we hit that 100 million, we will accept the applications.
And is this starting January 1, 2016?
Correct.
All right, now, how, now the renter and the other credit, how do you administer all this stuff, by the way? I mean, this seems like you've become into an impossible burden with the number of employees you have. Is that a fair statement? I know, I know.
No, actually, the fair statement is we have incredible employees.
Oh, all right.
And I think we do a great job. We do have challenges each year, but each year we deliver. This credit is something that falls into something that we do on a regular basis. Every year, we have what we call our annual cycle. We look at the legislation that's been passed, the changes that need to be made, the changes that need to be made to our processing system. We're actually in a better place now that e-filing has increased as much. We have about 90% of the people are e-filing. It's easier to make a change on the electronic filing than with the paper filing. So it's actually easier for us to manage, and we can be more nimble now in the electronic age.
All right, now back to the circuit breaker. Can someone actually get a renter's tax credit when the building owner is not even paying taxes?
Yes, because this is based on what that individual is paying, and it's focused on providing the relief to those that need it most. The individual paying the rent doesn't know if the person that they're paying to has.
No, I mean if it's non-taxable, if it's a subsidized building. Obviously, their rents are determined based on the fact that it's an unsubsidized building, and the owner's not paying it, or the government, whoever owns the darn thing. Why would you presume that they should get part of their rent back when nobody's paying taxes on the building?
And I think that's what Senator Savino was talking about. And the way the bill's written now, that it's for the individual, the burden of the individual.
On the assumption that somebody's paying taxes, therefore their rent goes higher. Okay. Well, we'll see. We'll look into that one a little bit. All right. As far as the administration of it, I file my taxes, I make the computation, what my income is and so forth, and if I'm below the income, I actually take the credit. So it's like any other tax filing. The burden would be on you to show that the taxpayer is being untruthful. Is that fair enough?
Well, the burden is on the taxpayer to be truthful in their return. We do analyze every return that comes in to make sure that it's right.
Okay. I'm not considering fraud, I'm just trying to
No, it's
say that it is a heck of a burden, because all different calculations and
it's not when our analytics, we don't look at it all as fraud because there are complexities, so it's questionable or it's people not understanding. We stop about 250,000 returns that come in to question, and some of those are probably fraudulent requests for refunds. Last year, we stopped $450 million from going out that we didn't think should be sent out. For something like this, where there's additional credits, we would be doing the checks. We'd have the third-party information. We have the information from the locals. So we'll be doing that calculation behind the scenes in our system to make sure that they're eligible.
Last question. If you're a taxpayer and you are a low-income taxpayer, well, not a taxpayer, if you file a return and you get an earned income tax credit, and that credit is greater than your tax liability, you get a check back, correct?
Correct, refundable.
Give me an idea how many dollars worth of checks come back every year to people that are using the earned income tax credit? Ballpark.
So your question is how many are entitled and we send out, or how many do we stop?
How many, no. How many dollars goes out every year?
Actually, I might have that.
You might actually-
If you
No.
could send it to me.
I can get back to you.
You
get
could
back
send
you
it to
on
me. And if this circuit breaker results in another credit for someone who doesn't pay, actually gets money back every year, would that just be added to the money that they get back?
If they're due the credit, yes, it would get added to it. It would run through all of our checks to make sure that they're entitled to it. Our system does allow us to make inquiries on one part of a refund and not another. So we may if we're questioning an earned income tax credit, yet somebody is entitled to a real property tax credit, we'll send out the check for the real property tax credit, but not the earned income tax until we can validate it.
Okay, thank you.
Thank you.
Senator Hamilton is here as well.
Thank you, Chair and Madam Ranking Chair. Good morning.
Good morning.
I'm not that well versed in property tax, so I'm just trying to find out, is the property taxes for everybody assessed the same every year from a base year? Is the base year like, was it in 2010?
Well, let me take that one. The property tax is basically reassessed annually. Every year there's a new assessment roll. In theory, all the properties could, can, and should be looked at every year, but customarily the prior year's assessments are often carried forward. But it is an annual process generally, not a...
So when was the last year all the properties were assessed at the same time together on an equal basis at 100% evaluation?
Well, it depends on the jurisdiction.
Okay.
It's a local tax.
So let's go with New York City.
New York City does annual reassessments.
When was the last time it was based at 100% evaluation?
Excuse me, the last time in what?
Basically, every year there's caps on property taxes, right? 6% a year, no more than 20%
Yes,
of a
that's a
5-year
separate-
period, right? So when did
yes.
that actually start, that cap?
That cap went into effect when Article 18 was enacted. Article 18 of the real property tax law was enacted in 1981.
Right.
And I believe that cap has been in place since then.
So the base year for all practical purposes for property assessment without having revaluations in 1981 for New York
For
City?
purposes of the cap, but that cap, that 6%, yes, has been in effect since
So
1981.
we would agree that the assessed value and the market value is not in sync? Or is it the same?
There is an issue between, yes, the cap does keep assessments at a level which is generally lower than they would be without the cap.
So what percentage of the assessed value would you say is of the market value today?
Well, I know the city has targets that they, Class 1 property, residential property is generally assessed at 6% of value, and the other three classes at 45% of value.
No, that's not the question I asked you. I said, what percentage of the assessed value is of the market value today? The assessed value is what you're taxed at, right? And you have the market
Yes.
value where the properties are sold at.
Yes.
What's the percentage of the assessed value to the market value?
Well, those are the percentages. For Class 1, it's...
I know that the 6% of the market value is your assessed value, but let me rephrase the question for you. The value for taxation for a property, where does that value come from?
The value comes from the marketplace, so there's three
But if
approaches
there's a
to-
cap since 1981 at 6% a year, no more than 20%, and the appreciation has outpaced that cap,
That's true.
so there's a disparity in what you're taxed at and what the actual market value is. Can we just get to that point?
Well, I don't think, I don't know that there are figures. If there is property that has over...
So you're
over-
telling me that you don't know that what the property is being taxed at and the market value are similar? Or are you saying you just don't know?
I think it's a case-by-case question of whether, how the property...
There's no way it could be a case-by-case basis. If, since 1981, property values can't go more than 20% in a 5-year period, and appreciation, I bought my house, let's say, for $250,000. Now it's worth $1.5 million. It's a cap on my house of when my property taxes can be increased, 6% a year. So you're telling me that with the cap and the days market value, properties are being taxed near the full market value?
Well, if the market has gone up, has
All right,
consistent...
we can move forward, because, you know, okay. You're not- you- Oh, okay, so we're not going to get anywhere with that question, okay. So let's go for the star exemption to personal income taxes. Basically, you said the star is going to be transferred into income tax, personal income tax? Credit?
I'm sorry. So is your question about Star back in the 1990s where?
No, I'm moving forward now. We're coming present day.
Okay. So the personal income tax credit.
Right, personal income
for
tax credit,
property
right.
tax credits, yes.
So, well, it's a disparity between New York City's property tax, how people are taxed on property taxes, versus Long Island. You know, where property tax in New York City could be $4,000, Long Island you have $10,000 to $15,000. As far as the personal income tax credit, would there be a disparity as far as who gets what, as far as reductions versus Long Island versus New York City for a senior? Because now you have a fixed income. You're not making a lot of money. Well, hopefully you have a fixed income.
It's, the credit is to address people that need it most, that are most negatively impacted by their property taxes.
Okay, well, that's really, with the program now, let's go with the enhanced star and the star exemption. How much money do we spend on that a year as far as property taxes not coming in?
The enhanced audit,
And the star program.
the enhanced STAR program. I don't have the number on that right now.
Is it 100 million or?
Oh, the total cost
Total-
of the
total
state
cost
for the
for-
programs
yes.
is about $3.1 billion.
3.1 billion?
Billion. Yes.
Okay. And how much do we give away for the 421A exemption?
For which
The
exemption?
421A property tax?
That,
We
we
don't
don't have that
administer
figure.
that program.
I said United States, I'm sorry. 1.1 billion. All right. Thank you very much. I appreciate it. I'll come back later. Yeah.
Thank you, Senator.
Thank you. The governor is proposing a number of closing of sales and use tax avoidance strategies. So he's trying to, I guess, close what I would call loopholes. Can you tell me a little bit about what these changes are and how you think it will impact behavior of taxpayers?
Okay, some of these loopholes are a result of some tax planning, which is not illegal, but there are some loopholes, such as if a company uses an associated company out of state to make a purchase of a high dollar product. So they purchase this out of state, and then they bring it into New York State. Since they're closely associated, it's the same company, and they don't have to pay the use tax because it was purchased out of state. What this would do is it would require that that company in the other state have been in place for 6 months prior to make sure that it really is a company in another state and not just set up for this. Other parts are where you have closely held that are transferring products and saying that they're for resale, but they're really not for resale. They might be leased to the other person, to the other part of the entity, and with that lease, they could be spreading the tax out over the life of the lease. What this would do is it would require that the tax be paid up front.
And then in another section of the Article 78 bill, did I say Article 78? Article 7, sorry. We're not discussing a lawsuit, Article 7. He also makes some proposed changes that he calls tax expenditure reform. That seems to me some of it can intersect with the questions I was asking you about tax avoidance strategies. So is anything between the tax avoidance reform and the tax expenditure reform going to address a problem that has been pointed out to me, that we have these things called as-of-right expenditures where they are tax abatements, but because they are granted as of right, they aren't treated as expenditures or tracked in the same way in New York state law, so that an as-of-right expenditure can be a significant source of foregone tax revenue and be seen by some as a loophole, but the way that we have our laws set up, they don't even get tracked as abatements or expenditures. Do either of the sets of changes the governor is proposing this year help us get at that problem?
I'm going to ask Amanda to see if she can comment.
I just want to make sure I'm understanding the question. Certainly, there are changes in our tax laws, for example, within the personal income
Can you
tax.
pull the mic a little
Oh,
closer? I'm
sure,
sorry,
certainly.
Amanda.
I mean, there are changes within our tax law, for example, within the personal income tax where, if you're eligible for the credit under the law, that's a reduction in your tax liability. And that may be hard to capture, to have a lot of visibility into, although we certainly do strive to do that. I don't think that the tax loophole closers that we were talking about have a lot to do with that. These loophole closers are on the sales tax side and are intended to address, abuses of our sales tax system that we've seen on audit. I think it's a cycle. People find loopholes, we notice, we close them, they find new ones, and there's a cycle around that. And so this year's a set of loophole closers.
So, again, there's a bunch of different sections of proposed tax changes in policy. And also it includes some reform, I think, of IDAs.
Yes.
So I think, I'm asking him in sections because I think it all integrates somehow, but I'm not totally sure. So you've got some expenditures reform, you have, now you have IDA reforms. One of the other issues that has been raised in the past is that things like pilots, local government land sales and leases, IDA deals, up until now, there's no role for tax and finance to say, wait a second here, don't do the deal, or, oh, the deal was done, and somebody's perhaps given away their local taxes or their county taxes, but, oh, they've also done away with the right of the state to tax. And sometimes we find those are very large sums of money that the state never had a say in it, but our state revenues disappeared. So between the IDA, the expenditures, and the avoidance strategy reform sections of the budget, are you going to have more power to say, no, the state of New York actually either A, doesn't approve this deal, and or B, well, maybe we can't stop the deal, but no, you're going to continue to pay your state taxes? How does that all, that's what I was finally getting to in the questions.
That's exactly what the IDA bill is for, so that we can go in and we can audit the program that is being given the IDA sales tax benefits. ESD identifies, they identify what the programs are, but this does give us the ability to go in to see if they actually met the requirements of the program and to protect the state sales tax part of that program. A couple of other parts of the bill, and actually in the IDA too, is it requires that they check with us to make sure that the company that they are contracting with is tax compliant. We're looking to move as much of that as possible up front so that the state is not spending state money on a contractor that is not paying the taxes that are due.
So you can stop the deal before it's done, and you have to, tax and finance will now have to sign off on it.
Yes.
And then after the fact, you can also audit and say, no, actually, this
Correct.
isn't okay, you owe us this money.
Correct.
And is that true for pilots as well under the new law?
Not on the pilots, no.
And on land lease at local government level, land sale or
No.
land lease? So
Not-
just the IDA section?
Yes, yes.
Would you agree it's a good idea for the pilots also?
I would be a proponent for as much upfront checking as possible. We obviously can't do too much at the local level, but we would work with them, yes.
And, oh, I have 0 time. We'll see if anyone else has a question first.
We've been joined by Assemblyman Thiel.
And Assemblywoman Malliotakis.
Great. Are there, no assembly questions? Because then I'm going to keep rolling. Thank you. 1 second. So the City of New York has supported a group of New York City corporate tax reforms, and it's a long list. Is it relatively parallel to the changes in the state tax reforms we did maybe 5 years ago now? Does it? I don't remember how long ago it
No,
was.
the tax reforms were done last year to come into play in 20.
So these city tax reforms are the matching with?
They match to our
Last
reforms
year's.
of last year.
Okay.
The practitioners and businesses are very supportive of the city conforming.
And the city projects that it's tax neutral for them. Does the change in do these changes somehow impact tax revenue to the state?
They would not impact tax revenues for the state. The city administers their own corporation tax. We don't administer their corporation tax.
But sometimes when one level of government changes the way they tax corporations, everybody rushes to their accountants and changes their structure under tax law, so sometimes it does anyway.
Yeah, we've seen that, but we don't believe that's going to happen here. We're working very closely with New York City on this.
And then the state is also, the governor, has also proposed reducing tax levels on small businesses that I believe you're defining as under 100 personnel and how much revenue?
The top is $390,000 in revenue, but it is phased in. The maximum benefits would be given to those that are under $290,000.
And what's the estimated loss in tax revenue to the state with this change?
Let me see if I have that here. I don't have that. I'll get it for you.
Okay, if you could get back to me.
Sure.
And tying in my last question about the changes in the city tax reform and the state's proposal for a lowered rate for small businesses, which I think is a very good idea, by the way. Is there some interrelationship between the package of city tax reform and the state's lowering of taxes for small businesses that will relate to each other in a way that isn't so obvious?
A relationship between the corp reform of last year and the reduction for the small businesses in the corp. Last year, it reduced the corporation tax rate from 7.1 to 6.5. Prior to that reduction, 6.5 was the tax rate that was for the small corporations. So that was why it was required that we bring this down. We brought it down even farther than expected to the 2.5. I'm not sure what New York City is doing with that.
Okay. Is there any, it's a silly question to ask you to predict this, but I don't know who else I would ask. Is it a possibility that a larger corporation would break themselves up into 10 subsidiaries of under 100 employees to take advantage of a tax rate that drops from 6.5 to 2.5 over X number of years?
Well, I don't think it's likely. I've seen a lot, with the way companies structure to maximize, but that would require a lot of administrative work, a lot of different returns that would have to be filed. They would have to show business reason behind it. With the corporation tax, also, we combine all of their businesses that are closely associated. So most likely would not be of any benefit.
And would the state have an ability to say, yeah, that's not what we meant, you can't do that?
Through our corporation tax audit. It's unitary, so it requires that they combine all of their associated businesses.
Then, one more question, I'll be done. In your testimony, you said that the governor is giving you the authority to recover inappropriately claimed STAR exemptions. How much money is out there that you don't have the power now to collect that you think you'll be able to collect?
It would be $80 million with the information we have now. However, there are still some things in the works.
So you think there's even more that you could be collecting?
Potentially. I think the $80 million is the majority of it.
Thank you very much.
Thank you.
Senator?
This is the lightning round, very quick, precise questions and answers. There's a appropriation of the budget to complete the contract with Source HOV.
Yes.
Has any differences between the state and that company been resolved through a settlement?
It's, we're no longer working with Source HOV, and we've been able to work out of that contract.
Okay, so is the reappropriation to pay part of what?
It's,
We've already concluded, Source HOV is no longer processing for us. We still have some final contract issues that we're closing down with them, and the reappropriation is to cover final payments for the processing work that they did do in 2014.
All right, because of any issues, did you get them to reduce what you should have owed them if they completed their contract properly?
We settled the work we settled 2013 already, which was the year of the most significant processing failures. Last year, we in-housed a large proportion of our paper processing, and this year it'll be fully processed in-house. But Source HOV did do some processing last year.
All right, so
we're just working out the final payment issues.
Okay, but it was resolved anyway?
Yes.
yes.
Okay. Secondly, something in the budget for a $4.1 million new cigarette tax task force. Do you know anything about what's planned?
Yeah, we have a cigarette task force, strike task force that was actually started last year. And we started it last year because it required joining forces with many local and federal and other state enforcement entities that are looking to combat the illicit tax. And what the idea there is to stop the influx of the untaxed cigarettes into New York State, and also to be able to track the money. So this partnership with this task force gives us the insight into both into all the federal systems and the multi-state systems, so that we could track where the money's going and really stop it from happening at the root.
Okay. Since the cigarette taxes have been going up progressively over the years, has there been a decrease in net tax collected?
The tax collected has gone down. It's not clear. There's also the number of people smoking has gone down too. So there are a number of different factors that go into
Okay,
play.
could you say over the last 5 years, give me the amount of taxes collected by the cigarette tax?
I can get that for
Yeah,
you.
thank
Yeah.
you.
Thank you. The executive budget proposes a variety of tax reforms, credits, and enforcement actions that are expected to result in a revenue loss of $227 million in the 2016-17 fiscal year, $1.4 billion by state fiscal year 2018-2019. Key proposals include a circuit breaker credit for homeowners and an education tax credit, which you've spoken about, and various program extension and significant tax enforcement actions. Question one, you were talking about all the other money that we're doing to save. How does those numbers run against the 227 and the 1.4 billion? Is there any close reality one to the other?
Well, there are a lot of different factors that
how
go
much
into
are
those
you
numbers.
saving versus how much are you giving away?
The budget includes a number of pluses and minuses, as we've seen here today. Are you looking for the net, or? I'm not-
Yeah, no, I'd just like to know
Okay.
how much of all the things you've been talking about this afternoon,
Mm-hmm.
how much millions is that, or is it millions that you're saving?
It is millions that we expect to have in savings. So what I could do is I could get back to you as to how much the savings are.
I'd like to see how it
Sure.
correlates to the amount of money that we're giving back.
Okay.
And can you discuss the tax implications between the different levels of taxpayers' income classes, as well as the efficiency implication of the executive's overall revenue proposal?
Can you tell me what the question was?
I'll give you, that was the question.
Okay.
It was a little, I have very good writers for me.
I want to make sure I'm answering. So-
Did you get it?
And I'm not clear, I'm not sure
Can
as
you
to,
discuss the tax implications between the different levels of taxpayers' income classes, as well as the efficiency and implication of the executive's overall revenue proposal?
well, the tax implications when we're talking about the real property tax credit, that is for the low and middle class, middle income people. There are a number of different things that could impact people at different income levels. Because there are so many factors involved there, it's not easy to,
So you don't know which level each one is at?
I don't have that information as to what level, no.
Can we sort of get something on that?
We'll look to see if we can
Yeah,
pull
I'd
it
like to
together.
see the
It's
level.
because we don't really know until people start filing their taxes, things
But you
change.
can tell by the class that they're actually earning to get to these programs.
We can make some implications, yeah.
All right.
Okay.
Any further questions? Yes, Mr. Thiel.
Good morning.
Good morning.
I don't know if this is, yeah. I have a question about the sales tax, the state sales tax on motor fuels, on gasoline. Back in 2006, when gasoline was $4 and $5 a gallon, we capped the state sales tax at 8 cents, which effectively is at the 4% rate of $2 a gallon. Now that before taxes, gasoline prices are below $2, in essence, we are taxing a gallon of motor fuel at more than 4%, which would be a higher rate than anything for sales tax. Has any thought been given to maybe changing that now, so it's 4% or 8 cents, whichever is less?
It's not in this budget, so. And with gas prices changing all the time, I don't think it was really expected that it would go this low.
Well, I
so.
don't think anybody in 2006 expected that it would be below $2.
Yeah.
I think it's kind of an unintended consequence that now the tax rate is actually higher than a flat rate. So
Right.
I'm just wondering whether or not, you know, it probably is maybe a penny a gallon or something like that right now, but it may be something we might want to consider.
Understood, yeah, thank you.
Thank you very much.
Thank you.
We've been joined by Assemblyman Walter.
Empire Center for Public Policy, Edmund J. McMahon, President.
Good morning, Assemblyman Farrell, Senator DeFrancisco, other senators and assembly members on the committees. Thank you very much for allowing me to testify today. Last year, as part of the 2015 budget, you approved New York's first permanent broad-based state tax reduction and reform since the start of the Great Recession. The changes you made to the corporation franchise tax and estate tax codes will help make New York a more attractive and competitive place to live, work, and do business, and that's a goal I know we all share. However, there remains much to do. Looking ahead, the legislature should consider its tax policy options in the context of all the tax actions enacted by the state since the onset of the Great Recession. In 2009 and 2010, the state raised taxes and fees by a total of $7 billion, which is not only the largest tax increase in the state's history taken together, but one of the largest tax increases enacted by any state during the economic downturn. And on top of that, separately, there was the targeted tax increase throughout the New York City region for the MTA. An array of tax cuts enacted since 2011, many of them only temporary, have at least partially rolled back the immediate post-recession increases. However, it's important to realize that the state's tax burden has been redistributed, but on net not reduced. For example, personal income tax collections this year will continue to be at least $2 billion higher than they would have been under the permanent law in effect as of 2008. the effective income tax rate, which is tax receipts as a share of personal income, is well above the average level between 2002 and 2008 and near its highest point ever. Now, the most significant tax change proposed in Governor Cuomo's latest executive budget, as you've been discussing with the tax department, would create a new personal income tax credit designed to drive $1.7 billion a year in subsidies to roughly 2 million homeowners throughout the state and a smaller number of renters, mostly in New York City. The credit is supposed to serve as a circuit breaker, as you know, for those whose property taxes exceed 6% of their income, for those earning up to $250,000, with slightly different parameters or somewhat different parameters for renters. There's a geographic disparity inevitably, unavoidably, when you create a credit like this. The largest average savings inevitably will flow to downstate residents, residents of downstate suburbs, where property values are highest and taxes are typically a larger share of income, and income taxes are also highest. The credit also is likely to disproportionately benefit older retired homeowners who are most likely to be living on reduced incomes in homes that are worth many times what they originally paid for them. By the same token, senior citizens, of course, are also more likely to have paid off their mortgages and thus have lower monthly expenses. In this sense, the proposal entails yet another form of intergenerational wealth transfer to the retired from younger, higher-earning workers. Now, as you've also been discussing, obviously the state already funds a very significant homeowner property tax break in the form of the $3.4 billion STAR program, which gives school districts aid to in turn pay for a partial homestead exemption. Enhanced STAR benefits are available to most homeowners 65 or older, the same group of people who are likely to benefit disproportionately from the proposed credit. The other changes the governor has proposed to the existing STAR law are expected to reduce annual STAR outlays by a total of $280 million by fiscal 2019. Nonetheless, even at that reduced level, if the governor's proposal is enacted, the state by 2018 will have not one but two homeowner property tax subsidy programs costing a total of nearly $5 billion a year. Both STAR and the proposed property tax credit are subsidies designed to treat a symptom rather than dealing with the underlying disease. You'll be applying $1.7 billion in Band-Aids on top of $3.1 billion worth of aspirin. Instead of creating yet another state property tax subsidy, the state should instead reconsider, and the legislature should reconsider a few basic questions. If your policy goal is to provide across-the-board homeowner, quote-unquote, relief based on property values, then STAR represents the best approach. On the other hand, if you aim to help only those homeowners who literally find their taxes to be unaffordable, in the word so often used, then a circuit breaker is the better way to go. But New York doesn't need both approaches, certainly not funded at this level, especially now that the property tax cap is clearly doing its job of holding down tax levy increases, especially at the school district level. The best way to help all property owners, homeowners and businesses alike, is to permanently enact the tax cap, whose fate is now tied to the continuation of the otherwise unrelated rent control laws. Instead of creating new and superfluous tax breaks, the legislature should consider other tax priorities that I would argue would do more to boost the tax competitiveness of the state. One example to start on the relatively smaller scale, the governor's budget includes necessary technical corrections to the revised estate tax provisions you enacted last year. This is an opportunity for you to also repair a glaring problem still embedded in the law. Now, as you know, last year, prior to last year's cut, the state was one of the few states to have any estate tax, and it affected estate values starting at just over $1 million. By raising the tax exclusion in stages over the next 5 years to match the federal exclusion, which is now $5.4 million, you're going to be producing a great deal of relief and freedom from taxation for literally hundreds of thousands of families, small businesses, and farms, many of which probably don't suspect that they would have been subject to the tax. However, the final legislation, and this is not included in the governor's budget fix, the final legislation also preserves outdated aspects of the old law, including what's been called a steep tax cliff. The result, as one leading accountant and estate lawyer noted, is a confiscatory 164% marginal New York tax rate on estates valued at between 100 and 105% of the federal exclusion amount. The technical fixes required as part of the next budget give you an opportunity to fix that problem so that the estate tax on the state level, like the estate tax on the federal level, features a true tax threshold rather than a vertical cliff. Remember, the cliff really affects the people who are at the very lowest end of those estate values. And while $5 million to $6 million is a lot larger than $1 million, it doesn't take much for the owner of a small capital-intensive business to have assets at that value level. A second and much broader set of concerns is presented by the many loose ends in New York State's personal income tax code. In December 2011, the legislature extended, and again in 2013 extended, a significantly higher tax bracket for taxpayers earning $1 million or more, or $2 million for joint filers, combined with rate cuts for filers earning between $40,000 and $300,000 on a married joint basis, and a long overdue indexing tax brackets to inflation. But all of these changes are temporary, set to expire at the end of 2017. Now, New York's temporary higher income top rate is among the highest imposed in any state, and it's an economic negative because it creates a disincentive to work, save, and invest here. The personal income tax is also an integral part of the business tax climate because a significant number of firms, including sole proprietorships, partnerships, and S-corps, are subject to this tax. New York small businesses in particular would benefit from a more competitive and predictable, and I would stress, given the temporary nature of the tax structure now, predictable income tax structure. Economic considerations aside, fiscal stability is another substantial reason for you to begin phasing out the so-called millionaire tax. 20 years ago, at the end of Governor Mario Cuomo's tenure, the personal income tax was 51% of our state tax receipts. By the way, 15 years earlier, when the tax was at its all-time high, it was only 45% of our tax receipts. This year, it's going to be 63% of tax receipts, which is itself an all-time high. And it's expected to rise even further to 64% in 2017. We're more reliant, among the states that have personal income taxes, we are more reliant on the personal income tax to balance our budget than all but a couple of states. About 43% of the personal income tax receipts now come from the top 1% of tax filers. That's people whose incomes begin just below $1 million. That means 27 cents out of every tax dollar you raise from every source comes from about 100,000 tax filers. That's not a great number in a state with 19 million people and a $1.3 trillion economy. Many of them are business owners and investors, and by nature also include a lot of footloose business decision makers. Now, there are clear risks associated with depending so heavily on such a small number of taxpayers. When high-income households have a bad year, the entire state government suffers fiscal stress, and that happened in between 2001 and 2003, and it happened again between 2008 and 2009, and you are more dependent on those taxpayers now than you were then. And in that case, we're far more dependent on high income, on the top 1% of taxpayers in any state with an income tax except California. So that is not a stable situation and a sustainable situation for the future. In sum, the best way to build on last year's progress in reducing New York's tax burden would be to eliminate the confiscatory cliff in the reform estate tax, to permanently enact across the board and currently temporary cuts in personal income taxes in the middle class brackets, and to adopt a schedule for phasing out the temporary tax increase on the highest income individuals and businesses. And while it may not be an immediate executive budget issue, the best way to offer a promise of lasting property tax relief, or at least the starting point, would be through the permanent enactment of a property tax cap, of the property tax cap. Thank you very much, and I'd be happy to take any questions you might have.
Thank you. Anyone on our side? Okay. Senator Kruger.
Good morning, EJ. Thank you for testifying. So you talked about the STAR tax credit, the circuit breaker. We would have two. You highlighted in your testimony the STAR tax credit, the way it's set up, seems to disproportionately be of value to senior citizens in home ownership, even though they may have already paid off their mortgages, and isn't means tested related to a tax burden putting them at risk. If we got rid of the STAR program, what do you think we would see afterwards?
Well, the current STAR program? Well, the current, what you would have is, if you wiped away STAR overnight, it would have, I think, a noticeable impact on the real estate markets, because I think the value of STAR, again, especially downstate, is capitalized into the values of home. Look at real estate ads, and they'll say, here's what the tax is with and without STAR. I think, in fact, there were some local studies done when STAR was being implemented, that it was having an effect on prices of real estate, for instance, in the Hudson Valley, because it had such a notable impact on taxes. So if you wiped it out all at once, you'd have an effect on real estate values. It's interesting, the governor's approach of phasing it out is interesting in that respect. In other words, personally, I've not been a great fan of STAR for a number of reasons, but it would be I think it might be disruptive to get rid of STAR now, certainly. A lot of people have gotten used to it and live with it. There are seniors who really need STAR and count on it to make ends meet. There are seniors who get enhanced STAR who arguably have no need of it and would be fine without it. The problem is both programs can't fine-tune themselves to picking out automatically, as it were, somebody who has real need, no matter how you define it. The closest thing to full-blown means testing is a circuit breaker. If you say, our goal is we have this chunk of money and we want to help people who can't afford their taxes, then you take the more means-tested approach, while understanding that you have a statewide circuit breaker, you're still not going to have an even effect. You're still not going to have you're still not going to avoid circumstances where the retired couple who are doing fine paying their bills get an extra tax break for the house they paid off, while the middle-aged couple in their prime earning years next door with 3 children, one heading into college, who live in the identical house, get no break. That's just the way it'll happen, more likely upstate than down, by the way. But if STAR, I think STAR has more of an effect on real estate values than a circuit breaker would. But there's 2 discussions you need to have is, do we want to do this at all? So that is, subsidize property taxes to the tune of billions of dollars. Then secondly, what's the policy goal, which should shape how you do it?
Thank you. You also testified about what you see as the negative impact of having higher personal income taxes compared to history. Is it also, though, true that we have lower corporate and business taxes now than we had in those same historic periods? So we've traded decreasing corporate taxes and increasing PIT, and you would say, I guess, also from your testimony, the estate tax issue. Are we better off we spend about $2 billion a year in business tax credits. Would we be better off doing away with the business tax credits and being able to lower PIT? Would that meet the criteria for you in a more effective way?
As another witness here said last week, that's a very good question. I think, yes, it would actually, for the most part, be better. I think many of the business tax credits are highly questionable. I think that there was some work done by and on behalf of the Governor Solomon Commission a couple of years ago that called into question whether many of those business tax credits are justifiable. And I do think it would be worth taking a look at many of those credits to determine to get rid of them and basically use the proceeds to help restore the personal income tax code to its prior level, the top rate to its prior level.
Thank you.
Thank you. Thank you very much. I'm sorry, Senator.
Sit down. Okay. Don't go off too far. Do you have handy, I don't mean today, but to provide to us, the least useful tax credits that would be something that we could transfer over towards reducing the property income tax?
Oh, I think no credit combines expense and lack of net economic value more than the film, motion picture on TV.
You're absolutely right.
I think that there's an increasing array of research to support that point of view. The contention behind the credit The credit is based on the presumption that none of the employment and production that occurs in New York would occur without it. I think now more than ever that's clearly not true. I think it's been carried to a ridiculous extent, and that it should be the first target for elimination. And it would free up $400 million a year ultimately for broad-based tax reduction.
Okay, can you speak up just a bit?
Yes.
But now, this cliff, the cliff in the estate tax,
Yes.
would you just explain what the cliff is, how it works, and
Well,
why it's a bad thing?
So, at the risk of oversimplifying a bit, our estate tax was designed for another era. It was designed to fit into a niche in the federal estate tax as it stood in 1999 and 2000, and to create an amount of state tax that fully equaled the maximum federal pickup credit as it used to be under the old federal estate tax. So it's not the way you would write the tax if you were just creating an independent state estate tax, or if you wanted to complement, if there is such a thing, the current federal tax. It combines our own exclusion with our own rate table. What it effectively does, because the old federal estate tax is gone, was phased out in the 2000s, and has been replaced by a new streamlined federal estate tax that in certain key respects is very different from the old one. The new one, to oversimplify a bit, is essentially like a flat tax that applies to your entire estate once you get past a certain range of the threshold. So you have an estate that's a little beyond whatever the federal threshold is in 2019, $6 million. The whole estate is subject to our tax. The federal tax doesn't work that way. It works the way you would assume a tax works. That is, the federal government has a rate table. It has an array of rates starting very low and going up to a certain level. I actually forget what the top level is, but it's lower than it used to be. And the first several hundreds of thousands of dollars are at the lowest rate, and it goes up, just like a personal income tax code does. But our estate tax basically clobbers you with the full brunt of the tax on the whole estate once you're a little bit beyond the exclusion point.
So if the exclusion is $5 million, you have $4.9 million in assets when you die, exempt from New York State tax.
Right.
If your gross estate is 5.1 million,
Well, still none. Well, if it was $5 million, the exclusion, if you get 5.1 or 5.2, all of a sudden, whammo, you've got the tax on the whole.
That's the point, on
yeah,
everything,
on
including the
everything.
first $5 million.
Right, and nobody, that's a really, obviously, a really bad tax. Nobody would design a tax that way. We didn't design it that way for any good reason. It was simply an artifact of the way that our state estate tax used to fit into the old federal estate tax. And it really is indefensible. I've talked to, one of my motivations here, there's a small businessman who owns a small manufacturing plant in the Albany area. This is not somebody you would, this is not, a global mega billionaire. But when you have a capital-intensive small business, you can easily have a business that you're looking to pass along that's worth $6 or $7 million, or will be by 2019. If that asset value is a little above the federal exclusion level, then that's going to make the difference between that business owner being able to pass along the business to his heirs or have to break it up and sell it. Because it means the most for illiquid assets that are close to or on the bubble.
So if that weren't enough of a reason for people to leave the state if you have some assets, you're saying, according to your report here, that 23% of all of the personal income taxes are paid by 200 and something.
43% are paid by about 100,000.
About 100,000 taxpayers.
For 100,000 filers, right.
Filers. 100,000 filers pays 43% of the income tax.
Yes.
That doesn't seem fair to you, does it?
Well, here...
I mean, if you want to keep these people to pay some taxes, there's a breaking point, I would assume, when someone would say, when it gets to 60% of the taxes are paid by 90,000 people, at some point, somebody would say, what am I doing here?
Here's the point. People could argue all day on what's fair and what isn't fair. Those people have about 24% of the adjusted gross income, for instance. So they pay 43% of the income tax because it's a progressive income tax. So the tax goes where the income is. But the point is, if you feel good about taxing very high income people at a very high level, you should also feel concerned about having so much of the state budget and, in fact, your fiscal future and the plans you're making in the budget in every way dependent on a small number of people who's basically, if a small number decide to shift their residences in greater numbers, you got an impact. Or if a small number, if they have a bad year, which is what happened twice in the last decade, you've upset the whole budget.
Okay. Thank you. Oh, wait, one other thing. No, I already asked it.
Okay. All right.
Thank you.
Thank you very much. Next, Ron Deutsch, Executive Director, Fiscal Policy Institute.
Thank you all very much, distinguished members of the fiscal committees and other Assembly and Senate members who are here today. I appreciate the opportunity to have my 10 minutes with you a year all together. I wanted to talk a little bit about the circuit breaker and the education tax credit, but given the conversation that just occurred, I can't seem to control myself, and I'm going to have to address just some of the points that were made. I grant you the fact that wealthy individuals pay a large share of the personal income tax, but you should keep in mind that the top 1% in New York, in particular in New York City, get about 44% of all the income in New York City, and in New York State they get about 33% of all the income generated. So this notion that somehow the wealthy are doing poorly or are going to flee New York, I think is a little ridiculous. And I think the number of millionaires in New York has actually been growing. It's not shrinking. So this notion that somehow, since we've increased the top marginal rate to 8.82% for people making over $2 million a year, they are not fleeing New York in droves for Mississippi or for Florida. And quite the opposite is occurring. And we talk about the fact that it's paid by 100,000 taxpayers with incomes over $1 million. Keep in mind, about half of those are not New York State residents. They are out-of-state residents that pay New York State taxes because this is where they make their millions of dollars. So with that in mind, I would also suggest that we should also recognize the fact that since the recession, literally 100% of all the income gains have gone to the top 1% of New Yorkers. The bottom 99 have actually seen a decrease. So keep in mind, their incomes have grown about 32 times that of the 99%. So with that said, I would also remind you that if we look at who's paying taxes in terms of state and local taxes, and we look at the different quintiles in New York, we should realize that the top 1% pay a smaller percentage of their income in state and local taxes than do the rest of us. The vast majority of middle-income taxpayers pay between 10 and 12% of their income in state and local taxes, whereas the 1% pay about 8% of their income in state and local taxes. And I think that this recognizes the problem that middle-income taxpayers are hit harder by property taxes and by sales taxes than they are income taxes. And the tax changes that we made, the quote-unquote millionaires tax changes that we made to the personal income tax structure, the so-called middle-class tax cuts that are contained in that are very, very small for the average working New Yorker. Whereas when you had an income between $500,000 and $2 million, the changes we made in 2011 reduced those people's taxes by about 24%. So they saw a large tax cut. I wouldn't consider someone between $500,000 and $2 million middle class. But with that said, let's move on to the fact of the circuit breaker, which my friend EJ called a Band-Aid. I would suggest it's much more of a lifeline to people who desperately need it right now. The governor has taken some great strides forward, I think, in putting this circuit breaker together the way it's structured right now. Is it the ideal circuit breaker that I and my members of the Omnibus Tax Consortium, groups like Tax Nightmare, New York State Property Tax Reform Group, Tax Reform Effort of Northern Dutchess, and many others across the state have been calling for a circuit breaker for years. The reason is there are 700,000 households in New York with incomes below $100,000 a year that pay more than 10% of their income in property taxes. There's 250,000 with incomes below $50,000 that pay more than 20% of their income in property taxes. So what EJ would call a Band-Aid, I again would say is a lifeline to many of these families. And this notion that somehow it's just seniors that are going to get this benefit or people in downstate suburbs, I think is also misguided. In fact, I put together some examples. So if you will, a family with 3 children with the average median income in that county of about $49,000 in the town of Greenwich that has a house valued at about $195,000, pays about $6,442 in property taxes. Once fully phased in under the circuit breaker, that family would receive a property tax credit of about $1,751, or a 27% decrease in their property tax burden. That is significant, and it's certainly nothing to scoff at. A family in Amherst, in the Amherst School District in Erie County, out in western New York, has an income of about $60,000, a home value of about $149,000, and taxes of about $5,500. They would see about a $1,900 tax cut under the circuit breaker proposal. Or rather, they would see a $959 tax cut under the circuit breaker proposal, which represents about 18% tax cut. So clearly, these tax cuts are going to go to people who need them the most. And the circuit breaker is not a new concept. 33 states have circuit breakers right now. Most of them also include renters. This bill would cover over 1 million homeowners whose property taxes exceed 6% of their income. The circuit breaker is targeted, so it provides the most relief to people at the lower end of the income spectrum. Our colleagues and the Fiscal Policy Institute have long supported this. One of the problems that we see with this is it's linked to the tax cap. So why would you condition tax relief to people who need it on circumstances outside of their control? It's not up to the individual taxpayer to decide whether their town board or county government or school district exceeds the tax cap. They shouldn't be penalized for that. They should receive the tax relief that they desperately need. I would also suggest that in terms of the circuit breaker tax credit, we should also be looking at things like increasing the residency requirement. Currently at 6 months. We might want to consider going up from there. It would also save some additional dollars. But we also should look at making the rent equivalent in this more like 20% of property tax, because that's what many economists suggest would be the proper equivalent for something like that. So moving on quickly, I would also suggest that the executive budget includes this education tax credit. I know the Senate's passed a version as well. The governor's proposal provides a 75% credit rate. The Senate proposal provides a 90% credit rate. Those are some pretty high credit rates for these type of contributions. I would also suggest that it's potentially an abdication of your responsibility as the legislature to direct where state dollars and state appropriations go. You're handing that authority over to potentially very wealthy individuals that will decide where they want their dollars to go, or really where they want our tax dollars to go, given the high credit rate that you're providing them. So Senator Krueger asked a question earlier what the average charitable contribution would be. On average, it's about 5%. So you compare 5% to 75% to 90%. Why would an individual, say, continue to give to their local food pantry, their local anti-poverty programs, their local synagogue, when they can get 15 to 18 times the tax benefit by contributing to one of these allowable education institutions? So I would also suggest potentially that this could be a violation of Section 7, Article 7 of the state constitution, that requires all appropriations to be distinctly specified. So I would keep that in mind too. So I would suggest that this has the potential to have negative consequences in charitable giving in other areas. And that may be one of these unintentional consequences that folks haven't thought of yet, but may be part of this as well. Very quickly, with my 45 seconds left, I know I can't testify at the economic development hearing because I'm only allowed to testify at one, but I would strongly suggest that you take a strong look at Startup New York and its impact and whether or not this is a cost-effective program. We've spent more on ads on this program than we've been promised in capital investments by the companies that are involved in it. Right now, the governor's also looking to expand it to airports in New York State. So if you can imagine, I mean, this harkens back to the Empire Zone program, where it started with good intentions, but then kept expanding and expanding and expanding to the point where it was kind of fraught with waste, fraud, and abuse. So I would suggest that you maybe hold some hearings on this program to determine whether or not it's the right program for New York. So thank you very much. Be happy to answer any questions you might have.
Any questions? Senator Krueger.
Thank you for being able to answer the question Tax and Finance couldn't answer about what the difference is between a current charitable contribution versus the tax credit under the education tax credit. I was estimating 25%. I appreciate your clarifying. It's more like 5% going up.
The
to,
average, yes.
I think as high in your testimony as perhaps you could reach maybe 9%, because you gave me the answer that I wanted to be able to, again, highlight. This will skew the outcome of the concept of charitable giving in the state. And then actually, Senator DeFrancisco did follow-up questions about the time frame you have to apply for these tax credits is, I think, 15 days, January 1st through 15th. Your typical New Yorker who might be interested in a charitable donation is not so likely to be able to file for a tax credit in the first 15 days with Tax and Finance. Would you agree?
I would definitely agree. I would think this is geared towards wealthy individuals and corporations that want to donate large sums to the schools of their choice or the educational institutions of their choice.
And I asked E.J. McMahon, well, I know that FPI is a strong supporter of the, not of STAR, but rather of the circuit breaker model, but I asked him what he thought the impact would be if we just phased out STAR. Were you listening? Do you agree with that analysis?
Yeah, I mean, I think property tax relief should be more means tested than it is. I think EJ and I have agreed in the past that STAR is not the best way to deliver property tax relief to people who need it, and that a circuit breaker is the better approach. But I think ultimately the problem is that the state has not been a reliable partner to local governments and/or schools. And the fact that the state share of school funding is at historic lows, the aid and incentives to municipalities also at historic 30-year lows. These are things that we need to be investing in, but I would suggest too that the 2% self-imposed state spending cap is part of the problem here. We're looking at $11 billion potentially in unspecified out-year cuts through 2019, which ultimately fall down on public education, it falls upon local governments, it falls upon human services. So these out-year unspecified cuts are also problematic because they're going to create more pressure at the local level as state funding continues to shrink.
And in your testimony, just on your recommendations towards the end, you say to fix corporate tax reform. So we did make some changes in corporate tax reform in state law last year. Your testimony says the tax neutrality commitment of that has actually cost us $500 million. In 1 year, it's already cost us $500 million?
I believe that's what it's projected to cost over the next couple of years. But in reality, Mayor de Blasio has also put forward a plan on corporate tax reform that would conform to the state's corporate tax reform, but he did it actually in a revenue neutral way by making sure that there was kind of an alternate minimum tax for New York City-based corporations so that they couldn't simply carry over losses or report paper losses and not pay anything. So he did close some of the loopholes that exist, and we would urge the state to do something similar in order to, in particular, around our alternate minimum tax.
Thank you very much.
Thank you. Thank you very much.
Thank you.
Mike Durant, New York State Director, National Federation of Independent Businesses.
Good morning. Thank you, Chairman DeFrancisco, Chairman Farrell, and the other members of the legislature here today, and for allowing me to testify on the governor's budget and the issue of taxes. NFIB represents nearly 11,000 small businesses all across the state, encompassing virtually every segment of our state's economy, from manufacturers to retail to agribusiness, sole proprietors. The typical NFIB member has 5 or fewer employees, and more than half of our members report gross sales of $350,000 or less. It is on behalf of those members that I'm here today. Our testimony is going to focus on 3 aspects of the governor's budget. Primarily the proposed small business tax cut. Starting quickly with the proposed assessment on fully insured health insurance plans, there's no shortage of stories written about the small business experience with regards to the Affordable Care Act, and healthcare costs continue to be a top-tier issue for our members. We're concerned that this assessment will ultimately get passed down and further increase costs on small employers. It's always laudable to increase healthcare coverage, but it does come with a price tag. So we oppose this assessment and urge its removal from any final budget agreement. Our second, quickly, is on the governor's property tax proposal. Like last year, NFIB strongly opposes the circuit breaker methodology. While the governor's rhetoric on New York's property taxes being too high, his mechanism of addressing this problem continues to miss the mark. NFIB is a strong supporter of the property tax cap. In fact, we would urge the tax cap to be made permanent this year. But shifting the tax burden will never lead to a serious discussion on addressing the costly, unfunded mandates that have led to the problem in the first place. Further, the absence of property tax relief for commercial property only heightens the tax issues that small employers face. Additionally, the $1.66 billion price tag of this plan is a leap of faith paid for by future budget surpluses that we may or may not have. It is our continued position that significant property tax relief should be a priority, but only based on addressing the root of the problem, not the potential fiscal restraint of the state. Which brings us to the proposed small business tax cut. I ask that when negotiating this budget and considering small business and their impact on the state's economy, that we consider a few facts. Small business is adversely impacted the most with the current mandated increase in labor costs, as well as the proposed hike within this budget proposal. There are more than 500,000 small businesses, accounting for approximately 3 million private sector employees and accounting for 98% of all business in the state. New York currently provides approximately $420 million in tax credits for the film and television industry. New York currently provides more than $320 million in tax breaks to the Startup New York program, not including the advertising of said program, aimed at attracting businesses to our state. New York recently enacted comprehensive tax reform aimed at reforming our business tax climate, but it was targeted to corporations, the banking industry, and manufacturers. The governor's proposal is a phased-in reduction of the corporate tax rate for small employers that meet specific criteria. In total, this tax cut is approximately $32 million and would benefit 40,000 small businesses, out of more than half a million. Our concern is not with the phased-in approach, nor with the income and employee thresholds. It is with the approach and within the context of the investments made by the state for economic development, which have less permanent impact on the present and future economy of our state. The amount of investment sent to attract narrow or temporary employment opportunities at the expense of widespread employment small businesses can and do provide. More than 90% of small businesses are set up as pass-through entities. The sole proprietors, subchapter S corps, and partnerships do not pay the corporate franchise tax. For these small employers, pass-through business income is taxed on the business owner's tax returns through the individual tax code. So while the governor has stated repeatedly that if his plan were to be enacted, small businesses would be paying the lowest taxes since 1917, he is speaking about a very small and specific group of small employers. In fact, according to the Tax Foundation, pass-through businesses account for 59.3% of the private sector employment, which is the 9th highest in the country. These are the small businesses being left out of the governor's proposal and have largely been shut out of the business tax reform enacted last year. While we support this proposal for our members that may qualify, we strongly advocate for a broad approach to small business tax reform. In no way will the tax climate for small business in this state be dramatically altered with this proposal. NFIB would alternatively propose a permanent and broad personal income tax reduction. Not only would a reduction in personal income taxes help sustain small employers, it would positively benefit those New Yorkers that need fiscal relief the most. There are other approaches which would be more beneficial than the governor's plan, but unfortunately would muddy an already convoluted tax code. From exemptions to carve-outs, targeted tax reductions for small businesses are possible and should be considered. As I previously stated, we have seen massive tax breaks aimed at attracting economic investment in New York through the startup program. We have seen significant tax reform targeting corporations and manufacturers. We are dealing with one phased-in minimum wage increase, a pending for tipped employees, and another proposed increase in this budget. To say that NFIB members and small employers generally feel slighted is an understatement. There is a never-ending push in Albany to increase labor costs that impact NFIB members the most, while they are continuously excluded from positive tax reduction efforts. This is a cycle that directly threatens the collective largest private sector employers in this state. If there was ever a time the governor and the legislature could roll up their collective sleeves to find sensible tax reductions for small employers, I would say it is now. So I speak to you today with a sense of urgency, but also with a dose of reality. Small business needs this budget to be sensible in its approach and broad and positive tax impact. Anything less will further threaten their viability and deepen their resentment of the tax and economic development policies that have been enacted and pushed in Albany. There are sensible and fiscally prudent solutions that will allow small employers to flourish and lead to the economic resurgence we continue to look for here in New York. Thank you.
Thank you. We've been joined by Assemblyman Levine and, yes, Senator.
Thank you. We've been joined by Senator Felder.
Questions? No. Senator?
One.
Senator.
Thank you. Thank you. Good morning.
Morning.
Would I agree with your analysis that the small business tax credit the governor's offering will affect way too few small businesses in the state? And I want to just reemphasize your point that it's only a $32 million deduction, total tax reduction, that will impact, you're projecting 40,000 small businesses.
Right.
And you say there are 500,000 small businesses under the criteria we're using, under 100 employees.
Right.
Would your organization support doing away with some of or all of the large business tax credits that now total almost $2 billion a year in lost revenue in order to deal with a broader and more equitable system for lowering the tax rate for, I would say, your 500,000 small businesses or the vast majority of businesses in New York State?
The Solomon report issued a couple of years ago talked about, at that time, around $1.7 billion of tax credits targeted to industry. Something that jumped out at me looking at this again last week is 0.1% of those tax credits are claimed by subchapter S corps, 0 by sole proprietors, and about 1.1 to 1.2% on LLCs. So to say that those tax credits are targeting a very specific group of people and excluding mine is an understatement. I would think that, yes, film and tax credit needs to be taken a look at. I think you could also, if we're going to bank on the budget surplus, putting in the circuit breaker, we could take a look at that and take some funds from that, apply them to more broad tax reform that would impact small business there too. So we're talking about money that is available. But I think the film and tax credit, the first one, jumps out. $32 million small business tax cut phased in over 3-4 years versus $420 million that we're giving to Jimmy Fallon and his friends is a problem. And I think that small employers equate to far broader impact on the economy than that is.
You'll know this better than I remember. What's the rate of job creation in small businesses versus large businesses in our state?
You're talking about over 3 million New Yorkers are employed by small business. You're talking around probably 59% of the private sector workforce is employed by small employers with 100 and few. So I think, to my point, any economic resurgence in our state, we need to positively start finding sensible solutions to their problems as opposed to targeted to making a movie for that temporary employment that's there for a 6 to 8 month period of time.
Thank you.
Thank you.
Questions further? Thank you very much.
I've got your private.
All right, thank you.
John Whitley, Legislative Affairs Officer, New York State Property Tax Reform Coalition.
Good morning, Assemblyman Farrell, Senator Krueger, distinguished members. Thank you very much for having me. And for the record, I'm John Whiteley, Legislative Affairs Officer of the New York State Property Tax Reform Coalition, a volunteer advocacy group that represents the interests of residents throughout the state who seek property tax relief and reform through state legislation. I'll be focusing this morning on the governor's circuit breaker, which we're enthused about, as you might expect. But just first, let me say that our long-term objective remains the gradual reduction of the continuing overuse of the archaic and inequitable property tax as a means of funding services in our state, and to gradually replace it with a significant increase in state funding, especially for schools, more in keeping with the state's constitutional obligations and the economic realities of the 21st century. The property tax hits hardest at the middle class, contributing to its decline amid a level of income inequality not seen since the eve of the Great Depression. As the governor again pointed out most recently in his State of the State address, we now collect some $50 billion in property tax compared to $40 billion from everything else. The underlying need for systemic, permanent reform that will centralize more of the overall funding responsibility and accountability at the state level is one of the critical issues of our time, and it needs to be seriously addressed now, this session. Unfortunately, the depth of the reform needed will realistically take years to design and complete, and for hundreds of thousands more middle-class New Yorkers, it will come too late to keep them in their homes and in their state. That's why Governor Cuomo's proposed new real property tax credit, basically a circuit breaker, is so extraordinarily important. This is a truly significant initiative. As most of you know, we've been fighting for a circuit breaker for years as an indispensable part of any property tax relief program, and there have been excellent bipartisan bills in both chambers. But this is the first time we've seen such a meaningful proposal in an executive budget. And we're grateful to Governor Cuomo for recognizing the depth of anguish and frustration of residents across the state over the unreasonable burden imposed by this miserable tax, and for his willingness to take this initiative in response. In short, we support this bill. That doesn't mean it's perfect in every respect, but much of what could make it better would involve higher costs. A particular example is the $2,000 maximum credit. We think if the bill is enacted as is and the tax department monitors actual circuit breaker usage, as the bill requires, it will show a significant number of households coming up woefully short of what they really need and what the formulas would otherwise provide. But this bill will nonetheless provide meaningful help to hundreds of thousands of deserving New Yorkers who have waited too long already. We can't let the search for perfection betray their interests. There is, however, one feature of the bill which causes us deep concern because it would exclude from circuit breaker coverage some of those who need it the most. And let me explain. One of the unique attributes of the circuit breaker is that it goes to individual households based on the relationship between their individual property tax and their income, independent of the overall financial well-being of their community. Some of our most overburdened residents are found in affluent towns or school districts, virtually all of whom include a minority of homeowners who are struggling. The smaller that minority, the less impact they have on school boards or municipal leaderships, and the less ability they have to muster even the 40% strength needed to block an override of the tax cap. And the greater the majority of affluent residents, the greater the likelihood they will override. The struggling residents in these communities, essentially powerless to prevent escalating budgets supported by the majority or supermajority, are at least as vulnerable to being forced from their homes as their counterparts in less affluent communities, perhaps even more so. And surely it's not reasonable to exclude them from the lifeline that only a circuit breaker can provide. But by requiring a cap-compliant local budget, this bill would do that. We understand the basic rationale for linking property tax relief to the cap, but we think in this instance it's not likely to have the intended effect on spending levels, and in the process it will unfairly penalize many of the very households the circuit breaker is designed to help. Our sense is that where supermajorities are able and willing to pay higher taxes and believe an override is needed, they will not generally be deterred by the inability of some of their residents to get a circuit breaker. The governor's bill is estimated to help about half the state's households, but that percentage will vary widely from one community to another. Where that percentage is small, as suggested above, the more likely the override. As for communities where more residents qualify for the circuit breaker, please bear in mind that each of them, each beneficiary, will be paying their full property tax up front, and even after deducting the subsequent income tax credit, virtually all of them will have still paid more in property tax as a percentage of their income than residents who do not qualify for the circuit breaker. They're not likely to lose their interest in keeping local spending under control and adhering to the cap. For the above reasons, we earnestly hope that the circuit breaker benefit can be decoupled from the cap. Thank you very much. Happy to respond to any questions.
Questions?
Thank you.
Thank you. Darla Ramfo, President and COO, Children's Scholarship Fund, Coalition for Opportunity and Education. Is there a replacement here?
I'm here.
Yeah. Might be easier for us to come in and just sit up here. Took you 10 minutes, you used your 10 minutes up
Yes,
just getting in here.
Thank you very much. Thank you, Chairman DeFrancisco and Chairman Farrell, for allowing us to come here this morning. My name is Darla Rumfo, and I am the President and Chief Operating Officer of the Children's Scholarship Fund. It's the largest K-8 scholarship program in New York State. We provide scholarships to about 8,300 kids in the New York City area. CSF is an independent, nonprofit, non-sectarian organization. We're not affiliated with any religious denomination. With me today is a representative of the thousands of children and families that CSF has helped directly through our scholarship program. This is Jorvelyn Tejada. She's a former scholarship recipient. She lives in Washington Heights. She actually lives in Chairman Farrell's district. She is now a senior and an honor student at Notre Dame High School in Manhattan, and she's in the midst of applying to college. CSF is also part of the Invest in Ed Coalition, which has more than 100 organizations that represent community-based nonprofit education providers, organized labor, business groups, high-needs communities, and religious entities. So I have several representatives of these organizations with me here today. I'd like to introduce them. At the end is Rocky Barlow. He's the Director of Arts and Education for Walk of Arts Kids in Brooklyn, which provides arts enrichment education to children in public schools. Next to him is Jason Pagan. He's the Director of Legislative Affairs for Queens Council 23047 of the League of United Latin American Citizens. Next to him is Antoine Allen. He's the principal of St. Mark the Evangelist School in Upper Manhattan. It's a school serving a low-income population with more than half of its kids on scholarship, many of them supported by the Children's Scholarship Fund. I should note that the average income of our families is around $31,000, so we don't help wealthy people. And then to my left, again, is Jorvelin, and to my further left is Julia Pignataro, who's the president of the Federation of Catholic Teachers, Local 153. You have my written testimony in front of you, which explains more fully exactly how the Children's Scholarship Fund works, who we serve, and any of us here are happy to answer any questions. I just want to say that I am here today because I have seen what the scholarships mean to the families we serve over the past 16 years. And I know that everyone sitting at this table knows that whether it be through scholarships or through the other efforts that would be uplifted through this legislation, that the most important thing that we're talking about is the kids. There are no do-overs, and educational opportunities missed mean life opportunities that never happen. So thank you for letting us be here today, and thank you so much for considering this legislation. We're very grateful. Any questions for me or anyone else here? We'd be happy to entertain them.
Thank you. The young lady, you were from Washington Heights?
Yes.
Where?
And 158th Street.
158?
Yes.
Down the block from where I live.
Oh, wow.
I live in the red buildings on Riverside Drive.
Oh, okay.
What's your number, 500 or 600?
499.
499. That's between Edgecombe and St. Nicholas, or St. Nicholas
Yeah.
in Amsterdam.
Correct.
Yeah, when I was a kid, I lived on 940, right around the
Oh,
corner.
wow.
What he's,
welcome.
What he's saying is he supports your group 100%.
As long as it's in the district. Any questions? Thank you all very much.
Thank you.
Okay. This is moving quite quickly. Can't believe we even have a break in between.
Jake Adler, New York State Policy Director, Orthodox United. Nobody's responding. You sure we got the wrong person missing? Is Jard Adler, Day School Advocacy Manager, United Jewish Appeal type? Is he here?
Okay.
The trains weren't coming in from New York City. They're both from New York City, so they probably just couldn't get here.
Keisha said neither has dropped anything up there.
Okay. Thank you all very much. We're finished until 1 o'clock.